for now, when you look at the numbers that they've printed, extremely good, extremely healthy. They should be happy with where they are. But when you look at what their stock is actually doing for the year, down more than 10% across the board, other than JPMorgan, and even JPMorgan is red for the year, it tells you that there is some nervousness in the system out there. Not so much about how banks will handle it, but because banks are considered a good proxy for the broader economy, any concerns about the pace of growth, whether that's recession or even slower growth, which is what Ted Pick said, the consensus seems to be slower growth, not no growth. That's still not going to be a good outcome for the banks at the end of the day. And that's why some trepidation in their comments today.
Yeah, and we saw definitely some swings in the share price today as well in all of them. Hey, Alison, come on in here. What's kind of the key takeaway here?
So I think JPMorgan volatility helps their trading, and they've used that to sort of set aside some money for the growing risks. I think, what's important is if you look at the underlying quarter for JPMorgan, obviously I thought it was very robust, and they had sort of $500 million in upside to trading. They also had a gain related to First Republic of about $600 million, and so they used that to set aside $1 billion in loss reserves. Compare that to Wells Fargo, where they had a slight release. But then if you look at the underlying numbers, JPMorgan now, a weighted average view, 5.8% unemployment rate, and that's about similar to Wells Fargo is. So in a way, Wells Fargo had sort of stayed a little bit more conservative. They have a different loan mix. JPMorgan has more card. I think that's, for sure an area that I'm a little bit more worried about, just given the growth we've had. It has higher loss rates. So, and by the way, like 40% of JPMorgan's reserve was for card. So JPMorgan, I would say, the model benefiting from volatility helps them to provide for some of the risk from that uncertainty. And Wells Fargo, just a little bit softer, right? So as I said, they're not much happening with the reserve, but net interest income was a little weak, demand a little weak, and I think that's why the shares are a little weaker.
So, Alison, given what we heard from these three banks, and we still have some to hear from next week, how would you characterize their view on the economy as it is right now, trade, tariffs, and potentially any red flags?
I think, the view on the economy is, I think, similar to the rest of us. We have to see what happens with tariffs and a lot of the uncertainty, and there's a lot of unknowns, and hopefully we'll know more by the time next time earnings rolls around.
So clear as mud.
Right, exactly. Clear as mud, but factoring in, so like what JPMorgan said is like, look, our base case is still very benign, but we're going to factor in more of a risk of a downside scenario.
All right, so listen, I got to just say, we were all kind of looking forward to the start of earnings season so that we could talk about something else than tariffs. And obviously tariffs play into, the outlook and what these guys have to say. But, Sri, we just talked with you and kind of how we were looking forward to what we got from these guys. So is there something as we look in this environment where uncertainty is the watchword that we got from them in terms of, yeah, folks, you should be worried because these are the guys that matter. They see the financial system.
Look, it's an interesting question because for the longest time we've looked at these bank earnings results not necessarily to see how good their bonuses will be at the end of the year, right? That's what matters to them. But for us, it's a bellwether for what comes ahead in the broader economy. And maybe this is something Alison could address, because one thing I've been thinking about, not an original thought, has come up a few times, but I do feel it plays a bigger role increasingly. Are these big banks necessarily a true bellwether when you consider that they have stopped playing a role sort of in the riskiest spots of the lending market, whether it's the mortgage market or the consumer debt market? Can you really look at their results and see if we're seeing a turn in the economy, or do we need to look elsewhere?
What do you think?
I think it depends on the business that you're looking at. So I do think that from a card perspective, right? So JPMorgan, biggest card lender, obviously focuses on the higher segment than some other card lenders. Bank of America, when we hear from them next week, we really do look at their consumer trends as an underlying bellwether. The thing is, right, is that nothing has happened yet. If anything, what we saw, and JPMorgan alluded to this, is that we've seen a little bit more front loading of the spending, right? So people that maybe want to make a sizable purchase or, some things they wanted to sort of get in front of any uncertainty. We've also heard this from our retail analysts. We saw it in some of the Fiserv data.
Right.
Spending holding up. People were surprised, right? But those numbers are through March. They're through March 31st. And so a lot of the uncertainty is happening now. And if you look at all the deals that are stalled, as we've had a lot of IPOs reported to be on hold. And, looking more towards that side of the business, I think the most telling numbers are Goldman Sachs, Morgan Stanley, cutting investment bankers now. They do normally do that process at the end of the year. They're doing it early. We saw the similar thing a couple of years ago. Morgan Stanley did also allude to things like AI and technology, but, they also performance-based. So I think you look at those numbers and you look at some of those cuts, it's sort of telling on what they think is going to be happening with the banking fee pipeline.
I feel like we're not crazily worried, just real quickly.
Well, and to Alison's point, I think the divergence is there, right?
Okay.
If any pain in the consumer economy, it'll probably still take a few quarters to play
Fair.
out. But where you're seeing an immediate effect is because of the lack of confidence and because of the uncertainty, it is going to impact portions of the market that banks that are tethered to the investment bank and the investment banking business are going to see that effect, which is why I'm very curious how Goldman reacts not only through earnings, but also a few weeks beyond. Because even in the last 10 days, you've seen a little bit of weakness in that stock relative to its bigger peers. I want to see if that lasts or not, or if earnings completely changes the narrative on that.